Hello everyone, how are we doing? Welcome to Derivology. How many of us can hear me? If you can hear me, talk to me, type in the chat box. Welcome. We're sorry for starting late today. Life happened. So I want to receive your responses. Talk to me, guys. Most can hear me loud and clear from wherever you are. Okay, if you can do so, I want you to type where you are logging in from for me. If you're logging in from the United States, from Nigeria, from wherever you are, from Nigeria, from anywhere, let's know. Okay, that's amazing. We are really behind schedule, so quickly share this to all your platforms, your statuses. Let everybody know that Derivology is live. Please type in the. Someone should type in the link for me. I think it's bit.ly/TVB YouTube. So let's keep the energy up so we move straight into what we have for today. And I'm just really thinking to myself, how on earth are we going to cover all that we've planned to cover today, because we are really behind schedule. And I think, if someone was praying for an extra day, peradventure your prayer just may be answered, right? It's really dependent on how much of time I'm able to make available for tomorrow. Does that make sense, guys? Okay, so yeah, they'll put the link in the description so you can share it out to all your platforms, right? So if I don't teach tomorrow, if that's not possible for me, one of our instructors will be here to carry on for wherever I am ending. Does that make sense? So we have the complete schedule, because I was only scheduled for 3 days. Then we have something else to take care of, right? So let's go. Derivology today, straight into what we have, right? So I'll run through our slides, which are I'm going to start from day 2 slides, and that is because we haven't finished day 2's curriculum, right? And okay, let me do a recap. How many of us remember what I taught you guys yesterday? What did I teach on yesterday? I taught on what? I taught on 2 things yesterday. No, not that. Yes, I taught on 2 things yesterday. Let me know. I taught on our market rejection zones, and I gave you 2 of the market rejection zones, right? Let me see if you remember. Talk to me. If you remember the market rejection zones that I talked about yesterday, I want you to let me know. If you know the market rejection zones I talked about, let me know. Type it in the chat box, and we'll just get straight to what we have for today. Just a quick recap. Okay, that's amazing. Order blocks and inefficiencies, amazing, right? Imbalances, fair value gaps, whatever you want to call them, right? not all FVGs are inefficiencies, but that's really not the crux, right? So let's swing into action, right? So we looked at the MRZs today. That's the order blocks, the imbalances, right? So now today we'll be looking into liquidity grabs and mitigations. And now really these are just sprinkles, salts, chunks here and there of many things, right? Like I told you, for the order blocks alone, we have about 4 or 5 kinds of order blocks, and there are ways to refine these order blocks down to 1 minute time frame so you can get sniper entries. And the same goes for the imbalances, but we can't go that deep in this webinar, right? So we'll go into what we call liquidity grab and mitigations, right? So I'll go straight into what I have for today. Most likely, okay, this webinar will end today, right? We'll look up liquidity grab, then we'll look up liquidity grab plus market rejection zones plus mitigations. Does that make sense? And I will not deal with understanding IOF. We'll talk about proactive trading versus reactive trading, right? And then we'll just bring Derivology to a close, right? Okay, so I'm going to move a bit fast. There are two things I'll always say. Number one, one thing actually. If you don't understand what I'm talking about, go to www.tradebolu.com and take my basic course. It is 100% free, right? So let's move on quickly. We'll talk about liquidity grabs and mitigation. So I'm going to go to my notepad so I could draw, right? And I'm believing you guys can see my notepad. I'm using a software that has multiple screens, so I always want to confirm that what I can see is what you can see. So if that's the case, let me know, right? So I want to begin to write. So please give me that confirmation, right? Give me that confirmation. And if you haven't gotten your notepad, I'm going to give you just 1 minute to get them out, right? 1 minute to get it out, right? I want everybody all settled so we can get straight into what I have for today, right? So 1 minute to get it out and get yourself set, right? And also share the link to all your social media platforms. So once I come back in 1 minute, we're going to go straight into what we have for today. I hope that's fine, guys. So no problem. 1 minute, 1 minute, 1 minute. Okay, so let's get straight into what we have, right? So like I told you today, we're going to be looking at liquidity grabs and mitigations, right? And I'd like to start by saying this. There are really only four things, four types of orders in the market, right? We call one the buy limit, two the sell limit, three the sell stop, four the buy stop, right? And I want you to pay serious attention to what I'm talking about. There are four types of orders in the market. Did you hear what I said? Right? Okay. Now, there is really, I want you to pay attention, right? So you understand what I'm about to talk about. Like I was saying, there are only four types of orders in the market, basically, right? And I'm just saying, we know the first kind of order, which is an instant execution. Let me just add that, right? The instant execution, that is when you instant execution, right? Now that's when you just go and then you click buy and then you buy at the current price. Does that make sense? But when we talk about pending orders, there are four types of orders: the buy limit, the sell limit, the sell stop, and the buy stop. So now I want you to pay attention even as I explain. So let me just draw a few things. Now, what is the buy limit? So let's say this is price is going up, right? Now price has passed, but I feel it's going to come back to this region. Does that make sense? So what I could do is I could place a buy limit here, right? And expect that when price comes to this point, it will activate me and then continue going in the direction. So I want to take note of how I'm going to put it. For a buy limit, what I'll find out is that the price at which I want to buy is lower than the current price. Does that make sense? Right? Your feedbacks are very important to me. The price I want to buy at is lower than the current price. Does that make sense? I hope that's clear enough, guys. Okay, that's amazing. That's the price I want to buy at. Now, for a sell limit, the vice versa is the same, right? I'm expecting the market to come back. So where's my, okay, so for a sell limit, the market has gone, right? So I'm expecting, perhaps let's say I'm expecting the market to come back here. So I'm expecting the market to come back into this region, right? And come back and pick me. I want you to pay attention, guys. So I'm expecting it to come back, pick me, and then fly down. Does that make sense? So that's what we call a sell limit. For sell limit, the price that I'm expecting it to come back to is higher than the current price. Remember, the market is here, but I'm expecting it to come here. Does that make sense? Before falling down. But for a buy limit, the price, are we paying attention, that I'm expecting it to come back to is lower. I'll type that, right? Oh my goodness, I hope I'm going to be able to cover. So for a buy limit, it is an order set is a buy order. I know I'm explaining all of this. Buy order set below the current market price. I know this guy is shifting here. Let's move this guy here. Set below the current, okay, let's take out this guy, market price. Does that make sense? Right? And then this is set above. Explaining all of this so I can explain liquidity grabs and mitigations. Right, so let me take out all of these guys. Let me just take out all these guys. I'm trying to take out this object basically. Okay, so this is what happens for a liquidity grab. Sorry, for a liquidity grab. I'm explaining something and why it even happens. I really don't know how to teach shallow. I'm sorry. I have to teach it properly. That's how I believe things should be done, whether it's free or not. Okay, now for a sell stop. So this is what's happening. For a sell stop, the market is currently here. But me, what's happening? Let me work on this guy. Let's draw again. I'm coming, guys. Okay, so the market is currently here. So I'm expecting that the market is going to come low and then it's going to activate my order. So the market is going to activate my order and then just keep going low. Does that make sense? For a sell limit, remember, the price is here. I'm expecting it to come up, pick me, and go down. But for a sell limit, the price is already below. So I'm just expecting to fall down there, pick me up, and then give me some profits. Does that make sense? Perhaps I should leave these diagrams on, Now, when we talk about a buy stop, the same thing. The price is below. I'm expecting to pass through and give me some profits. This is a buy limit. The price is above. I'm expecting to come back, pick me, and give me some profit. So do we understand the difference? And perhaps don't understand the difference. You may have to take some time to look up, the basic course. I keep referring to that, right? So let's move on. So why did I say all of this? I like you to know, pay attention. There is really nothing like a stop loss. I hear what I'm saying. There is really nothing like a stop loss. Let me start by saying this. There is nothing like a stop loss, and I'm going to explain. For a buy, if I buy a product at 2 naira or $2, are you hearing me? I will only make a profit when I sell that product at anything above $2. Does that make sense? Let's use a buy for a case study, right? I won't touch sell because of the time. Does that make sense? So if my price is here and I buy, that's the reason why only when it goes up, that's when I'm going to have a profit. Does that make sense? Does that make sense? So if I want to buy, let's say I want to sell at $5 and the price is $2 now. If I buy at $2, I sell at $5, I made a profit of how much? I made a profit of $3. Let me just write that well. I made a profit of I made a profit of $3. Does that make sense? I mean, what's happening? Sorry. I made a profit of $3. Does that make sense? Now, I want you to pay attention so you understand how the market is working. Now, if there was a way for me to buy this market, are you hearing me? To buy this market even lower, if I was able to buy it at $1, are you hearing me? If there was a way that I was able to buy this market or this whatever I'm buying at $1, and I still sold at the same $5, what will be my profit? My profit will be greater. My profit will now be what? $4. Does that make sense? If I could further reduce it and buy this market at 0.5, then my profit is going to be what? 4.5. Does that make sense? So whenever institutions want to buy, they want to buy at the lowest possible price. Does that make sense? Are you with me? And I'm explaining something with all of this. If you're following me all through this point in the webinar, I want you to type lowest possible price. Lowest possible price. That's where they want to buy. And that's where the concept of liquidity grab comes in. And some things will begin to become clearer even to you. Are you with me? Okay, that's amazing. That's amazing. So let's move on. So let's take a typical retail trader scheme, right? Let's look them up and see what they will do. Let's see what the retail traders are going to do, right? Okay. So now you are a trader and they told you, okay, let me just explain what a stop loss is. I explained buy limit, sell limits for a reason. And I said something that there is really nothing like a stop loss. Now, if you know how to set orders, which if you don't know how to do, go to our basic course. Now, if I buy the market, you are aware that my stop loss will have to be below my entry points. Does that make sense? So let's say I entered here, my stop loss will be here, right? So this is my entry is here, and this is my what? My stop loss. Does that make sense? Right? Now, what does this mean? I want you to pay attention. Remember what I taught you about sell stops. That for sell stops, the market is above, right? So as it comes, what we're saying is we want to sell at this point. So what you are saying when you are actually setting a buy stop loss, what you are saying is actually simple. If this market comes below this particular level, I don't want to buy it again. Please, broker, sell the market to me. Does that make sense? So a buy setup, when you are trading a buy and you set your stop loss, that is actually a sell stop. Do you understand what I'm saying? That's a sell stop. So what you are saying is, please, I don't want this market again. At that point, anybody that wants to buy, sell it to them. Are you with me? Did you hear what I said? Sell it to them. To who? Does that make sense? So what happens is the market makers originally want to buy this market. And I hope what I'm saying is making sense. So they actually wanted to buy, right? But they don't want to buy from this point. Why? Because this point, your entry point, is a bit expensive. If they can get it even a bit lower, they'll make some more profit. That's why I did all of those analysis for you. So what they do is they know the places where retail traders have put their stop losses. All those places are cheaper prices. Are you with me, guys? So when the market gets there and you sell it, they will buy at that lower price, and then they'll take the market in their direction. And you'll be shocked when I begin to show you all these things. Right? So when you see things like this, so this is how you see things. And this is where institutional traders begin to take out retail traders. So this is what they told you, right? This is how retail traders will move the market. Now, or institutional traders, their plan is to go up, right? They want to buy this market. So they will come and they will take this market here. And then what happens? Let me take this up. As the market has gone, right? What retail traders are seeing at this level is what? A support. Can you see that? They're seeing a support. And so what happens? They say from retail trading, when it gets to a support, do what? Buy. And what do? They set all of their stop losses below the support. You see that? Now, when we have plenty pending orders, right? Plenty stop losses, that zone is what we call a liquidity zone. Why? Because they've told all the retail traders, set your stop loss there. So all the market makers, the institutional traders, they know, okay, we have stop losses here. And I said I'm not going to go to a sell because of time. We'll just buy. So what's happening? At that point, the stop losses are what? Sell stops. And what are they? They are saying, please, if you get to this zone, sell. And guess what? The market makers want to buy at cheaper prices so they can make more profits. I hope you guys are understanding this. So what happens is you learn support and resistance. And so you see a support, and let's say the support has held once or twice, right? Maybe the support held the first time and then the second time, right? So what happens is you now say, my goodness, this is a strong support. So next time the market comes there and then you buy. And now they begin to move and lie to you like they are taking the market up. And then you begin to see 10 pips, 20 pips. Yes, my trading career. And before you know it, what happens? The market comes back, takes out your stop losses, and they get to buy millions of others at cheaper prices, and then they eventually go in the direction. How many of us has this happened to? I want to get that feedback, right? How many of us has this happened to? Where you saw the market was growing. It looked like a perfect setup. Before you know it, as if they knew where you set your stop loss, they came back, just tapped it, and zoom. They now began to go in your direction. And this is where the fear of missing out comes. You now see people jumping in around here. People begin to jumping around here, and then their stop loss is now here, right? And their stop loss is so wide. So I want to get that feedback. If you understand up to this point, right? If you understand up to this point, type, what should you type? Perhaps you type stop loss or something. Okay. That's amazing. Exactly. I love the energy that I'm getting back. So you understand how the market works. Now there are 7 liquidity zones, right? And we cover this extensively in the courses, and I don't have time to really explain that in depthly step by step. There are 7 liquidity zones, right? And I show you how to navigate all of them. But like I said, I can't do that now because of the time. We really want to cover up all we plan to cover today, right? But for this, we'll look at 2 major liquidity zones. Number 1 is trend lines. Right? Trend lines. I'll just type 2 liquidity zones. We have trend line liquidity, and we also have, which one should I be? Let's look up daily liquidity, daily high and low liquidity, right? So we have trend line liquidity, and we have the daily high and low liquidity. So now we're going to see some things, and some of you will be shocked. You'll be like, hey, this is why it happened. Okay, so let's just make progress quickly, and we go into MRCs and all of that joined together. Okay, so what is a trend line liquidity basically? Now, the market makers know what you guys know, really. Does that make sense? And they know what to do. So what they do is this is how they go. They induce, they trap, they shift. ITS. Does that make sense? That is, they induce the retail traders, and then they trap the retail traders, right? This is what we call liquidity grab. They grab all your stop losses, and then they eventually shift the market in their intended direction. Okay, so let's look up trend line liquidity and see what it looks like. So what did it tell you about a trend line? They told you when you see a trend line, amazing. That means whatever it means to you. It doesn't mean anything to me now. It actually does. So you see the first tap. Let's take this guy here. So you see the first tap, second tap. You see that third tap, and then you come. Oh my goodness, this trend line is strong. So you come in here, right? So guess what? Where did they tell you to set your stop loss? They tell you everyone their orders here, and you tell me if I'm saying the truth. Their stop losses at this zone. Their stop losses at this zone. Number 2, every hit of the trend line, their stop losses. Does that make sense? Their stop losses at this zone also, every single hit, right? And you tell me the truth. For bulk of you, maybe perhaps that's how you set your stop losses. Okay, so their stop losses there, and now you have joined the trail. You jumped in here, and then you set your stop loss. And guess what? The market makers know what they are doing, right? Because instead of them to buy from this price, this high price, they want to come and buy from this low price. Come on, look at the difference, guys. This is a lot of profit. You see that? So what do? They just bring back the price, break and take out all the stop losses, and then go in their intended direction. And we're going to see it in the market. You know what? Let's go to the market. Let's see an example of what I'm talking about. Okay. You see bulk of this happening on the lower time frames. So let's look at trend lines where the trend was not really their friend. Okay, this is one here. You see what I'm talking about? Can we all see this trend line? Smooth trend line, right? What do you see? Can you see this? Does it look like what you know? So what's happening? This is the first touch, second touch, third, fourth. Can you see how they broke the trend line? They took out the liquidity here. They took it out. They took out the liquidity here. Can you see it? Right? They didn't take out the third one. Right? And can you see immediately they were done taking out all of that liquidity? What do you see? We had a very impulsive move. Why? Because that is actually the direction they wanted to go in the first place. They just came back to play and take out liquidity. Let's look for another example. So you see this thing is everywhere, right? And I'll give you a few steps on what to do. Look at it. It's the same thing that happened here. We had a trend line here. Can you see this? Although quite steep. Can you see how there's liquidity here? There's liquidity here also. Can you see all of that? Can you see how the market came, took out all the liquidity at all the levels? There's also some liquidity here. All the liquidity at all the levels, broke through that trend line. And how many of you are smart? Let me see if you're already getting this. Can you see that we had an imbalance here? Can you see that? Where did the market come to? Exactly that imbalance, filled the imbalance, and what do you see? A rally up. This is a lot of profit. For those of you that trade VIX 75, you know what this can do to your account with the minimum. I think this move alone is about $75 to $100, about 50K. That's at the least 0.001. Can you see that? So can you see liquidity grab in combination with market rejection zones? Can you see that? So let's look for one last example, and then we just get straight to the other kind of liquidity that I'm talking about. Okay, we have an example here. Okay, no, that's not so good. Let's go to another pair so you know, or you see it's something that is everywhere. I'm trying to look for a trend that is relatively smooth. Okay, so let's see if we can find this. Can you see? There's liquidity here, but they didn't reach it. Or should I say they have not reached it yet? There's liquidity here, right? So it doesn't really look like they took out much liquidity. They just took out this liquidity here basically. Can you see? And then they came back. Notice where the market went to, an order block, exact spot. This is super amazing if you understand this, guys. Took out liquidity, came to the order block exactly, and reversed from that point. Right? I mean, this is. I always laugh when I hear people say trading is hard or it's scam. You just don't know what to do. Anyway, so let's see one last example. Maybe let's see 15 minutes time frame. If we find something amazing, we'll just go on. But if not, trying to find where liquidity was taking. Okay, so we have a very small trend line here, quite steep. Can you see? Exactly. Can you see how they came up, took liquidity, right? Rejected on this order block. You know, they feel this inefficient. They rejected on this order block, sorry. And what do you see? We have a move all the way down. Can you see that? Does that make sense, guys? I hope you guys are following this. That's amazing. So now we have seen how liquidity works with the trend line. Now let me show you the daily liquidity properties. Let's turn on our period separators. Okay, so now this is very easy, guys. Let's take off all the objects. Let me go to VIX 75. Let's take off the grid. Let's turn on our period separators. And let's turn on. Let's take off all the objects. Okay, so that's amazing. So now let's see something together, guys. I want you to look closely between this period, well, the 1 hour candle, between these period separators. I want you to take notes. We have a day, 1 day. These period separators are these like dotted lines. If you count these candles, there'll be 24, right? If you count the candles, those candles, you'll find out that they're 24 from here to here. Can you see? If you read in my chart, you see 24 bars. This crosshair, right? So in between the beginning of that candle and the end of the other candle is what? A daily. This is a day. Does that make sense? So this is a day, this is a day, this is a day. So all of them are days. Does that make sense, guys? Another kind of liquidity that can happen is that usually some trading styles will tell you go to the high of yesterday or the low of yesterday. Once you go there, you will find out that you can put your stop loss there. So at the high of the days, we always have liquidity, and at the lows of the days, let's take this for example. This is a very clear example, right? Can you see? This was these days lows. Can you see all the lows? And so some people will say, okay, we'll put our stop losses at the end. Now, can you see as this new day began, what you realize is that the market came down, swiped out all the stop losses, everything, just with one candle. And what do you see? An impulsive move from then on. Does that make sense? So while we have trend line liquidity, we also have the daily liquidity. Take a look at what happened here also. Can you see the high of these days? Can you see? The market came there, took all the liquidity there out. Everything. Took it out. And what do you see? A fall. And guess what? This is an hourly candle. So this is a straight fall for the next 4 days. Does that make sense? Okay. So if you understand what I just explained about liquidity graph, I want you to type LG in the chat box. Let me just get that response. Once I get that response, I'll be ready to fly even through. right? I'll be ready to fly even through. I'm sorry I'm not taking as much time to be as detailed as I would normally love to be, but we're behind schedule. Take a look at what happened here again. The lows of that day were taken out slightly by the wick of this candle. And what do you see from there? We've had an impulsive move all the way up, guys. So are we clear on that? That's amazing. That's amazing. I like the energy and the feedback. That's amazing. That's amazing. Right, so you understand what a liquidity grab is, right? So I'm trying to think of other terms, but basically they call it stop hunting, liquidity grab, whatever. It has a lot of names, but beyond the names that you'll find, the main thing is that you're understanding the concept, right? So it's not strange to you again, and you actually know how it happened. How it happened, sorry. Does that make sense? So that's super amazing, right? So let's move to the next thing that we have on our slides, right? And let's move on to the next thing that we have on our slides, which is, give me a second, guys. I'm trying to go straight into our slides, so we just walk through our content. So the next thing we have is liquidity grab and mitigations. So what is a mitigation? And I think that's a very important question. What exactly is a mitigation? Right? Hearing somebody saying things are unveiling. How many of you are just knowing these things for the first time, right? If you're my student, there's no way this would be the first time you're knowing this. Like, this would be like, I'm sure some of you, my students that are going through this, Derivology, be like, sir, why are you wasting our time now? We've cleared all of this. I mean, they're already waiting for the market. So please come quickly. Let's do analysis for tomorrow's market. But anyways, back to what I was saying. What is mitigation? Now pay attention. And this is very key. It's key that you pay extra attention within this place. Why do they go back? Remember, I was telling you something, that we're almost so sure that the market is going back to some zones to reverse. I want to pay attention. Mitigation, right? I may not have a clear cut definition of what a mitigation is, but simply this is the point where the market makers go back to MRCs. I mean, I think that's simple enough to understand. Does that make sense? So the going back is what we call the mitigation. So you hear them say things like the market is going to mitigate. It is going to go back. And the question is, why does the market go back? Why does it, or why do the market makers mitigate? Why do they mitigate? Why do the market makers mitigate? Good question, right? Why can't they just go in that direction? And I know some of you are like, they mitigate to take out stop losses, which is an amazing answer, but that's not all that happens. So let's use the normal support and resistance game that retail traders use. So the market is here, came here, went up. Does that make sense? And now came here, took out this liquidity, and now the market has gone. Well, let me draw something better. Let me think of something better. Sorry, I'm trying to think of something better so you can understand. Okay. So now, usually, what will you find out? The market makers will then come back, and usually there'll be an order block in this place. Let me draw shape. Within this region. Does that make sense? And usually, this is where they are going to move from. Right? So this is where we'll be looking to enter. Let me work on this block. Let's make the inside no color. Sorry. no color, and let's make this guy another color. Let's make it green. Okay, so usually there'll be an order block here, and you guys now know what another block is. And now by the time the market comes back, this is what you'll be looking to enter from, and you fly through. Okay, does that make sense? Amazing. Right, it's either there's an order block, or you find, perhaps an imbalance within one of the regions from whence the market will come back to. Let me just put this here, another block here, and now the market will just come back to that zone and fly through from there. God, I have a lot to teach, and it's 7, right? So it's about time to end. Should I end, or I should keep going, guys? Does that make sense? Well, this is a bit rough, so let me take out the second option. Okay, so let me take out these guys, right? So, but you understand what I just drew? It's coming back to the order block, and then it's going. Now listen, let me show you guys something. And this is why I'm confident, because I know why it happens. So listen, the market makers, right, lied. Listen, no, they lied that this market, they bought it, one, right, and so they induced buyers. So buyers came in, and then they put all of these stop losses here. So this place became a liquidity zone. DT zone. Can you see that? Now they came back. So as they were buying, they have a buy order open. Does that make sense? Buy order open here. Does that make sense? Now, because they want to lie, what do? They open plenty sell orders. So they have sell orders open here. I don't know if that makes sense now. So they have sell orders open here. Does that make sense? So when they reach this level, they opened up sell orders. Can you see that? A lot of sell orders. So the market started what? Selling. And guess what? Retail traders said, oh, some retail traders say maybe the market is selling. So now they opened, retail traders will start selling from this point. And then where would they put their stop losses? All of them will put their stop losses above the supports. So we have another liquidity zone. Some of you are like, my goodness. Liquidity zone. Here. You see that? So where do they have liquidity? They have liquidity here. They have liquidity here. They have liquidity here. Does that make sense? So now they are selling. Now they come and they've opened plenty sell orders, and now they have taken out the liquidity. So they are done with this liquidity. Remember, there's now another liquidity here. So now they taking out the liquidity, and now they continue this their buy order that they started here. They have not closed it, and their actual direction of the market. So they buy, once they are done, they buy the market back. You see that? So they have buy orders here. This is the first profit from here to here. They have another set of buy orders from here, even cheaper price, to here. Can you see that? Does that make sense now? Does that make sense? So they have a second buy order from here to here. So they've taken out liquidity 1. By the time they buy, all the people that are selling here, they've taken out liquidity 2. Are you with me, guys? So, but here is the challenge. Remember, they open sell orders to create these false liquidities. So as they have bought this market now, the sell orders are in a loss. Sell orders are in a loss. What are they going to do? Do you guys understand this now? You see how the market is working? The sell orders that they opened here, they have not closed it. But now price is at this point. So the reason why they mitigate, they will now come back. Does that make sense? What they are coming back to do is to come and close their sell orders. So they will close it either in a small loss or in a profit, because from here to here is a what? If you notice, from here, from this point to this point, to this point is a little profit from them, for their sell orders. Can you see that? So it's a little profit for them for their sell orders. So what you realize is that the sell orders will be in a profit, and then they will now close it, and then they will now move the market in the direction they move. They will continue their buy. So let me draw a schematic that is going to help you guys. Let me draw a schematic. And I know it's a lot. I expect you guys to watch this video, when I'm done. Right? Take time and watch the video. So let me draw a schematic for you. A basic schematic, and I'll just end Derivology with that, right? I really wished I was going to be able to cover some more, but there's this song they used to sing, Mercy Said No. Hope there's no Mercy on this call. Okay, the giveaway starts. If your name is Mercy on this call, talk to me. I remember saying I was going to do some giveaway. I'm excited now. Mercy, if there's a Mercy on this call, type Mercy. Some people are running to change their names. If there's a mercy, anybody on this call, the mercy of God has met you. So talk to me. Is there any mercy on this call? Is there any mercy on this call? Right, I want you to type. I want to see your name as Mercy as you type. Right, if this doesn't happen in the next 2 minutes, I'll just keep my giveaway. Right, is there any mercy on this call? So there's no mercy. Okay, so let's move on. There's no mercy. So this is a basic schematic you want to keep in your mind. Now listen. Let me just use a neat diagram. And I'll just show you a few examples, and we'll bring Derivology to a close. I really had a lot to teach you guys, but time always does not. So you have a support 1, 2, right? And then you have a liquidity grab from this point, LG, right? And then from the liquidity grab, what you have is a push up. Does that make sense? From this push up, there is going to be an order block. Does that make sense? Let me put this in red. Now this order block is where you are waiting for the market to come back to. Does that make sense? It's where you are waiting for the market to come back to. And once it comes back there are some MRPs. I only talked about MRZs. MRZs are market rejection zones. MRPs are market rejection patterns. So as it is approaching this box, there's a way the market will begin to behave. And I won't be teaching that. We teach that in our course, right? You can know this market is about to turn, right? And so what you're looking to simply do is set your pending order around here. Once your MRPs confirm this for you, right? You set your stop loss here, and then you set your take profit, your entry here, and then your take profit will be the next high. Now I want you to look at your risk to reward. This is when Forex becomes profitable, because this will be your stop loss, This will be your profits. And this is what trading is like. Not all those. Your sister's name is Mercy. Your sister's name is okay. No problem. Tell your sister that why she's on the call. I'm just saying that. Okay. So I'm going to go to the charts, mark a few examples, and we'll just call it an end. Okay. So I think we even already have a perfect example. So can you see? We have the first move here, which is, a liquidity zone created. And we see trades that would have worked out. Now, can you see the next move? Like I said, what do you see? The third move is a liquidity grab. Now, we're not looking to enter from here. The liquidity grab moved all the way up. And what did I say? The other block of that liquidity grab. This is where we join the MRZs plus. This is the other block. Can you see how the market came to that point? Once it came there, activate. Imagine your order was here. Like I said, your entry was here. Your stop loss was here. Did you notice how the market never reached your stop loss? And your take profit is going to be the next high. Can you see here? I have a question. Has your order been filled or not? Is this a profitable trade? Okay. So let's look at it on even lower time frames. I'll pick one last example and then we'll just fly on. I want you to see, can you see? There's a liquidity grab here. Can you see how this low, this particular low, took out this low by very little wick? Can you see that? Once it took it out, we are not chasing it. We just wait, right? See the order block before the impulsive move here. See how the market came back there and just gave us a very serious move. Notice the impulsive move after all of these things happen. So let's take up another pair and see what I'm talking about. Let's see what I'm talking about. Now this is a trendline liquidity. Can you see this? Okay. Now the trendline liquidity was taken out right here by this candle. Can you see? Took it out. Now once it took it out, are we waiting? No, we're not rushing. We just mark that order block. Can you see that? The order block that caused it. See how the market came there and see the rush. This is where we would have been looking to take our first TP from and break even. Can you see the rush of the market in that direction? Exactly. Right? So let's see if we could find some other examples. Now let's take a look at this example. Look at lows in yesterday. Right? Or see this, let's take a look at this trend line. And some of you are like, my goodness, how is he seeing all of these things? You don't buy experience in the markets. Can you see this trend line? Now, can you see how this market came here, took out the liquidity in this trend line? This market, this doji candle, took out liquidity. Can you see that on the next day? Once it took out the liquidity, right, the market actually began to go, and it looked like it didn't come back and pick us. What do you see? Days after, if you set your pending order here, came to you exactly, didn't touch your stop loss, and can you see where the market has gone? All the way here. Now please, what is your risk to reward? Look at your stop loss here. Your stop loss is 701 points. Your take profit is 7,000. So when I say people are making 1 to 100 risk to reward ratio, I'm not whining you. And this is just a basic strategy. I haven't taught anything. If you are in my course, you understand what I'm talking. This is just very basic. Very basic. Does that make sense, guys? It's the same thing everywhere. A basic way to trade. You wait for the liquidity grab. Look at it here again. All of these highs. Can you see the liquidity grab? Exactly. Can you see the candle that caused the liquidity grab? This region. Did you notice how we didn't chase it? We just allowed it go because we know they are coming back to close their orders. We mark our block. Can you see how the market came straight to our block? Once it came back to our block, it didn't touch our stop loss, activated us, and what can you see? The market just began to give us profit all the way. All the way. This is so simple. I mean, how on earth can you tell me that trading is hard? So can you see what I'm talking about? So this is so simple, guys. So I mean, I wish, like I said, I could have shown you IOF, how to know the direction of the market and all of that, but our time is far spent tonight, guys. So I'm going to ask you, do we have any questions? We're coming to the end of Derivology, and I promise to show you and teach you, and I've done this, right, with this basic concept of liquidity grab, mitigations, market rejection zones. I think you can do a lot more in the market than support and resistances, right? Okay, so let's round up our slides. We just go straight into our WPS slides, and we'll just round up. So proactive trading versus reactive trading. Proactive trading is people are trying to predict the market, which we are not doing. But reactive trading, you notice how we are waiting for the market to come back, which is the best kind of trading because we do not predict. Some people ask me, what's the difference between gambling and betting? Betting and trading. I say, for people that bet, they try to predict the major event. For us, we react to the events. So there's a difference. But that's not even what I'm getting to, right? So we've covered all minus IOF, which is going to take some time. So I've said why deriv. If you're thinking of how to get started, bit.ly/start deriv. That's how to get started on deriv. And then this is where we went to the charts, right? So do you have any questions for me? Let me know if you have any questions for me. Put them in the chat box. And while I'm waiting for your questions, this is the last day. Like I said, if you want to be trained and funded by me, I'll give you a fully funded $10,000 account once we're done. That's about 5 million. So if you want to be trained and funded by me, quickly log on to tradewithbolu.com, tradewithbolu.com, and click the professional course. Today is the last day for our Derivology discount on any of our courses. Use the words Derivology. Believe me, what you have learned is just a tip of the iceberg. We have MRPs, we have MRCs, we have refinement, we have how to know the kind of order blocks that will work. We have so much loaded in our course. That's where you get full-time mentorship from me, right? Quickly log on to tradewithbolu.com, click on the professional course. To get that course, make sure you join our vibrant Telegram community, and like I said, ensure that you connect with us. So I'll just take a while to take questions on anything. And I've heard people say, what's the best time frame to mark out order blocks? The answer to that is all time frames. So we actually do part of what we teach in our courses, which I can't do here, is top-down analysis, where we start from the direction, the time frame from whence we can spot the institutional order flow, and we go all the way to the 1 minute time frames, so we can analyze, and get sniper entries, right? So for some people, I heard them say things like, the charges on the website are quite high. Can I just make a transfer? Okay, if you're interested in doing that, send a message to t.me t.me/p_Pierce, right? So that way you get to make purchase without the charges that our third party offers us on tradewithbolu.com. Okay, so I think I do not have any questions, right? So watch this webinars again and again if you need to. And thank you for joining in at Derivology. We may have another webinar just to cover thoroughly. Maybe it will be 7 days boot camp. Right? I really underestimated what I knew to teach within this period, right? but we'll do better with our time for our next Derivology. Thank you so much for joining in. I'm sure you have learned something. Hop on our website, get any of our products while the discount lasts. So see you when I see you in class, see you anywhere, right? So like I said, thank you so much for choosing Trade with Bolu. You are welcome, like I'll always say, right? So let's have a great day. Great day, great day, amazing day, guys, right? So see you guys next time.